welcome to the channel Creative Wealth. Before we start our video today, I would request you to subscribe to the channel if you have not done. And if you feel that there is some story which we should know, please write it down in the comment section. Please click on the like button, click on the bell icon to stay connected.
How fund managers are making you rich. Discover the ways to tame the bear and ride the bull. Today, the mutual fund industry is supported by an army of fund managers and research departments that help them identify and spot opportunities as well as associated risk. This book looks at fund managers and their ability to make money for the investors. It also looks at the journey of the stock market from 1994 to the dot-com boom in the year 2000 and the infrastructure boom in the year 2007, and how these fund managers have managed to stay away from some of the biggest crises that hit the financial markets globally. Even though I may not agree with all the things that are there in this book, the good thing is Praveen's book gives the history of the industry, provides a deep insight into Indian capital markets, and reveals the investing style of some of the India's top fund managers. Land and money has always been defined the will and will continue to define a person's power and position in society. Even today, wars are eventually about acquiring more land and money. It was no surprise that physical assets like precious metals and land dominated acquisitions made by the common man too. With the advent of currencies, assets took another shape and form. While the value of land and the precious metals went up, the purchasing power of the physical currency would go down with time. But with the emergence of the banking system, currency held by the common man could be kept with bank as fixed deposits and continue to grow by earning interest. I believe this how the majority of the middle class Indian invested their savings. Even though buying shares of the company was another option for investors, the middle class avoided investing in the stock because the share bazaar was considered to be a den of thieves. It was labeled as a place where gamblers went to try their luck and rich people went to put in their surplus money. It was never a viable investment avenue. In most cases, they were right. Stock or equity markets were inefficient and stock prices could get manipulated regularly and investors could end up losing money. Equity markets made an indirect foray into the investment scenario. In the early 90s, through the route of mutual fund, investors started warming up to investing into mutual fund schemes like UTI, like MasterShare and UTI Scheme 64. By the end of 1993, mutual fund investment in India were mere 47,000 crores. With the UTI account of about 90% of the assets, investors were still wary of equity markets and invested in schemes only because they did not have a lot of exposure to the equities market. In 1994, things changed when the mutual fund industry was thrown open to the foreign investors. Morgan Stanley, a US-based financial service firm, launched the Morgan Stanley Growth Fund (MSGF) in Indian stock market. The Indian investors started believing that a foreign fund would have the ability to generate huge returns in the Indian market. To an extent that they were right because the high point for mutual fund was around the corner. In the same year, 3 more funds were launched. The Alliance Mutual Fund, a foreign fund, the Kothari Pioneer Fund, which was an alliance with the Pioneer Group of US, and the Birla Mutual Fund, and many others followed. The late 90s saw the phenomenal rise of the technology or the software stock worldwide. Till Feb 2000, people who invested in mutual fund made huge amount of money. The dot-com bubble burst and the large number of investors lost all their wealth in ensuring madness to the stock market. Investors felt cheated, but they slowly began to understand how the mutual fund industry operated. Sanity started entering into the market in the year 2003. And as a result, investors started coming back to the mutual fund industry. Fund managers were at the center of the decision making in the dot-com boom and the burst cycle. The really good ones learned from their mistake and were in a better position to manage their portfolio during the global financial crisis in the year 2008. Over the last 10 years, mutual funds in India were managed to regain the faith of the investors and have reached a point where many middle class families have some point of their investment in the mutual fund. Now, one can say this growth in the mutual fund industry is hardly anything significant. Considering the fact that this is in the country with a population of more than 125 crores, of which only 5% of them have invested in the mutual fund so far. As more people become affluent, there will be a need for investing in physical assets will fall, and they will start investing in financial assets like mutual funds. According to the Investment Company Institute, ICI research, 44.4% of the US household, or roughly 30% of the total population, invest in the stock market through mutual fund. India is expected to reach the same number in the next decade or two. From here onwards, the mutual fund industry is on the growth curve for a long time to come. Whether you are an expert investor like Rakesh Jhunjhunwala or a first-time investor, the possibility of both rewards and loss will always be there when investing in equities. The trick to making successful equity investment lies in mitigating the risk by keeping your ears to the ground and cutting out the noise that hides the real information. Only a handful of people, the India's greatest fund managers, include the fundamentalists, reach the roots of the information tree. They do so by engaging in fundamental analysis of the company, sector, and by understanding the basics of the product and the services that these companies sell. A fundamentalist look at macro issues, quality of growth and the promoters, return on equity and valuation. There might be times when even the fundamentalist will get it wrong when it is not about being an expert on a particular industry. To overcome this, they go to an expert who helps them take a long-term view of the industry and study the end consumers. The book reveals how the fundamentalists pick their stock and rule that they follow when they invest. There are experienced equity fund managers who have gone through the ups and downs of the stock market but still manage to give good returns to the investor over the long term. I bring you their stories. Though I have tried to update the latest figures, some information may have been updated after the book is written. Thank you.